Okay, we are recording right now.
Hi everyone, thanks for joining us at this ANZ pre-election economic outlook today. My name's Rachel Boyle and I'm the Executive Director at the New Zealand Chamber in Singapore. It's my pleasure to introduce Sharon Zollner, who's the Chief Economist for ANZ in New Zealand, and also Koon Goh, Head of Research at ANZ in Singapore. They'll be dissecting the economic implications of the upcoming New Zealand election and the effects on business in Singapore. Now, Sharon's going to give the New Zealand perspective first. She then has another commitment, so she's got to race off. So if anyone's got any questions for Sharon, I'll open up question and answers straight after her presentation for kind of New Zealand specific questions. And then we'll go on to Koon's presentation looking at the Asian implications. So please use the Q&A button that you can see at the bottom of your screen. So without further ado, I'll hand over to you, Sharon.
Thanks very much, Rachel. Right, I've got a few slides to race through, so I'll share those. Oh, look at that, seamless. Yes, so you might want to move your video boxes if they're obscuring things. But yes, Fortress New Zealand in the 1970s, that was about the closed borders for goods and import licenses and things like that. Now it's more about closed borders for people. So that's a pretty unprecedented situation and has a lot of implications for the economy, implications which haven't really been felt yet for reasons I'll explain, but certainly it does mean that this time is different, is perhaps more true than it normally is. This is a very unusual time. So countries are taking different approaches to COVID. New Zealand and China are aiming at the same target with slightly different strategies, it's fair to say, but we're going for elimination, and we've eliminated it once, and now we've eliminated it again. We've had quite a few days now with no community cases, but actually we've had 4 different incursions of COVID into the community in 6 weeks. So that really does highlight that that 100-day period was an anomaly, because we've had one mystery case, which probably came somewhere out of quarantine. We've had a healthcare worker in quarantine. We've had a maintenance worker in quarantine. And then we've had a guy who developed COVID after 3 weeks, which is very rare, but possible. But fortunately, the good news is that 3 out of those 4 were dealt with very efficiently by the testing and tracing and isolation scheme with no need for lockdown. So, and of course, the second lockdown, as you can see on the chart, was much milder. It was regional, it was only level 3, not level 4, it was much shorter. So it doesn't actually seem to have derailed things much, judging, or at least not much more, I suppose, if you want to be glass half empty about it, judging from the fact that business confidence actually continued its slow but steady improvement through that period, despite COVID coming back, which is great to see, because one might have thought that that would be quite a blow to confidence, the realisation that, in fact, as we were always told, elimination is an ongoing thing, not a one-off. So the good news is that we've now got fewer restrictions than almost anywhere. I've got a real client function with real clients after this. So I think most of the countries in behind this strategy, and happily it's looking like we might be able to get a travel bubble with at least some states in Australia by the end of the year. So previously Australia has sort of said, no, we need to open up our own internal borders first, and then what happened to Melbourne, of course, put that well on the back burner, but now they're suggesting they might open up to New Zealand state by state. So that would be good for our tourism industry, as well as our mental health of not feeling quite like we're living in such a fishbowl. So here you can see business confidence measures, or business activity indicators, out of our confidence survey. And as you can see, they have bounced back a lot, but they are still at recessionary levels. So essentially they look a lot like 2009, which was not a great year, basically. I've managed to put my videos all over my slides. How did I manage that? Right, and hide you all. There we go. So you can see we had a V-shaped bounce back, but we've stabilised sort of around 2008, 2009 levels, which isn't great. but it's to be expected, I suppose. So I find it useful to think of COVID as causing three distinct shocks for the New Zealand economy. There's the initial lockdown, which, the New Zealand lockdown was a very tough one, but the bounce back out of that was ferocious. The closed border, so obviously that's been instant insofar as people movements, but it hasn't really been felt yet, partly because of the seasonality of tourism and partly because migration takes a while to feed through to the broader economy. And thirdly, the slowdown in our trading partners. So of course, we're looking at a horrendous hit to global growth. There's a lot of uncertainty about how long it's going to last, given the fiscal stimulus that's been thrown at it. But our commodity prices are holding up pretty well. And that's because food supply is pretty disrupted as well as food demand. There are food security issues out there at the moment. China's trying to line up food supply. So our exports of goods are looking pretty resilient, which is very helpful when your exports of services have just been crashed by the border being closed. But here you can see more of the story that while it is a V, it's a very asymmetric one. So this is a measure of job ads. So essentially it's taken us back to 2015 levels, and that's sort of what the GDP hit did as well. So yes, a fast recovery, but an incomplete one. So the wage subsidy scheme was very fast and very generous, but also, of course, very expensive. So the government hasn't wavered on winding that back. They did put out a limited extension when we had the second lockdown light, but the numbers who went on that were actually quite small because most firms were finding actually that their revenue had bounced back pretty quickly unless they were unfortunate enough to be a tourism business. So we'll find out how many jobs have been saved versus how many job losses have just been deferred over the next few months because it's starting to roll off pretty quickly now. Another unknown for the labour market is, of course, how many Kiwis will come back to New Zealand. Why are they here? Are they coming to work, which is the usual reason, of course, migrants come, or are they coming because they've lost their job in Australia? New Zealanders have the right to work in Australia, but they don't have the right to access social security, so they can't get the unemployment benefit if they lose their jobs over there. So they are arguably the ones with the biggest incentive to come back to New Zealand. But if that's the mix, then your models saying what the economic impact of immigration is are going to be wrong. So there's a huge amount of uncertainty there. So obviously it's hitting different parts of the economy very differently. Through the lockdown, supermarkets had a lovely time. Online shopping has been accelerated. Agriculture sector trucked on. Forestry's doing well. Plenty of demand from China at the moment. Food manufacturing's fine. Construction took a huge hit to confidence and of course to activity during the lockdown, but has bounced back very quickly as the housing market has. Real question marks around the outlook for the commercial property sector with these big changes in terms of working from home and the hit to retail and hospitality, of course, will have consequences for commercial property. Central government always does well in recessions. Worst affected, obviously, tourism and accommodation, hospitality and retail are quite reliant on tourism as well, particularly in some regions like Queenstown. Students obviously aren't coming. And the housing market, well, you would think it would be badly affected because our houses are already very, very expensive, and this is a big negative income shock. Now, the tourism earned as much foreign exchange as dairy did, and yet we've seen anecdotes of an incredibly tight housing market and prices rising very rapidly. So I'll talk a little bit more about that, but it's pretty clear that those record low mortgage rates are definitely having an impact. So our prize for beating COVID-19, and now a second time, is a recession, unfortunately, but seriously we'll take it because I think we're all starting to appreciate things we've always taken for granted in terms of personal freedoms and the like. But we do have to be realistic that there will be the usual recession feedback loops between unemployment and then how much money people spend if they're worried about their job, and then the housing market and construction. But there is a very strange phenomenon going on at the moment, which is that in our consumer confidence survey, people say it's a terrible time to borrow $500 to buy a fridge. And yet in one of the other banks has a housing confidence survey, and there it's the highest since 2012. So people are saying it's a great time to borrow $500,000 to buy a house. And so I think that reflects partly that this hasn't really hit everyone evenly at all. But also that an economy is a slow ship to turn, always. And we're still kind of in the phony war stage. And those who were at the bank in the GFC have said a similar sort of thing happened there. The dust settled from all the chaos and we just started to wonder if we were all right, and then the shock waves arrived after a while. So yeah, here's the survey that I was talking about. You can see, again, a V-shaped bounce back, but an incomplete one. And in this case of the consumer confidence, it's only halfway back. And again, it's like 2008, 2009. So this is not the headline confidence measure, actually. It's the most useful question. Is it a good time to buy a major household item? And as you can see, that's really quite tightly correlated with household spending. And that little chart in the bottom left, you can see household debt is at record highs. It's crept up there as opposed to soaring like it did before the GFC, when we all sort of felt we were a bit bulletproof there. It got a bit silly. It never got silly. I think maybe it was starting to get on the verge of getting silly, actually. And I do wonder if maybe the Reserve Bank might have started to regret the fact that it had cut the OCR in response to falling business confidence, because it was starting to look like it had actually been a bit of a head fake. But then, of course, COVID came along, so we'll never know. But we have got this situation where households do have high debt, not nearly as high as in Australia, where their household debt is about 130% of GDP. But nonetheless, if you've got a lot of debt, then you're less nimble when trouble strikes. And that's true whether you're a household, a firm, or the government, indeed. So here's our forecast, but take anyone's forecast with a grain of salt at the moment. But our forecasts are basically quite closely aligned to those of the Reserve Bank and Treasury. We're a little more negative on unemployment, and the reason for that is that, unfortunately, it's the really people-heavy sectors that have been most affected here. So it's tourism, retail, hospitality. They all have a bigger share of employment than they do of GDP. So you can't just apply your usual models of GDP to unemployment. These are, it's going to really hurt the unemployment numbers. But not yet, because the wage subsidy, of course, has allowed firms to keep people on their books. The housing market, yeah, it's fair to say we have been surprised by how rapidly it's bounced back. There are a couple of reasons to be sceptical, though. I mean, people are out there talking it up as spectacular and amazing, but if you actually look at the sales, there's a pretty small overshoot. But the issue is it's been an overshoot in July and August, which are typically really, really quiet months for the housing market. So the year-on-year comparisons, this July versus last, look spectacular. And so there's this kind of narrative out there about the housing market actually just absolutely booming. And you look at the actual sales numbers, just in raw terms, it's not really clear that that's the case. They've been moved through time, but because of the usual seasonal patterns, it's making it quite hard to interpret. And also, it's important to note that housing listings haven't bounced. There's been no overshoot in housing listings, so you've had a bump in demand, but not in the supply. And so, but how long will that last? If we get a spring flurry and people listing their houses for sale, it could all turn around quite fast. But nonetheless, it is fair to say that the market's proving more resilient than we expected. And so we have dialed back our estimation of house price falls to something close to 5%, which is similar to what we saw in the GFC, actually. So mortgage rates, as you can see, they've come down. We expect them to continue to do so because we expect the Reserve Bank to cut the official cash rate by 50 basis points in April. So why April? Well, there's a couple of reasons. Firstly, they need to give the banks a chance to get ready for negative rates in terms of technically and legally. And secondly, because they said they wouldn't change the OCR for 12 months back in March. So basically, forward guidance is really important. When you get interest rates down to zero, you need to really convince people that you're not going to raise rates for a very, very long time, because that will help keep the longer interest rates low. So they won't want to go back on their word first up. So we think they'll wait till April. But that would take the official cash rate to -0.25%. And of course, there's lots of stories out there, and there was a Federal Reserve article overnight actually talking about the negative impact on banks' profitability. Of course, no one feels sorry for banks, but it is important that banks are profitable, that they can make a buck by doing what they do, which is intermediating between borrowers and lenders. If you get a credit squeeze because banks can't make that margin because you just can't take deposit rates for mums and dads negative. It would just be a PR disaster. So if you do get a squeeze there and banks reduce credit as a result, then you're actually it's counterproductive. You'd be better to leave the OCR where it was. So to try and head off that negative impact, the Reserve Bank's also talking about funding the banks directly at the OCR. So to get banks' funding costs down and enable them to lower their deposit rates more, which will enable them to lower their lending rates more. So generally speaking, these things can work for short times, but it all starts to get a bit perverse after a while, as well as mind-bending. But if you have very low interest rates for a very long time, then people who are saving money, whether that's for retirement or a house deposit, will figure out they need to save more because they're not getting any cumulative interest helping them out, for example. And there's evidence that happened in Europe. So when you get into this sort of matrix territory, it gets pretty weird pretty fast. And so it does need to be done quite cautiously. But the Reserve Bank's taking the view that if they go hard, then they'll hopefully be able to reverse negative rates quite quickly before any of these sort of cumulative negative impacts on the health of the banking system or on people's savings rates or on asset prices like house prices and whatnot, before it all gets too silly. So that's the theory. I'm a bit of a skeptic. But anyway, in the meantime, they're focusing on quantitative easing, printing money to buy government bonds, basically facilitating the big fiscal spend up. So you can see all that money's ended up in bank accounts. So at the end of last year, we had quite a big issue emerging where the demand for borrowing was high, but people were all taking their money out of the bank to go and buy a investment property or whatever. So the banks had quite a big funding gap. That's now closed, so that's not a constraint. But credit demand is. So as you can see, agriculture and business lending are dropping away, but household lending is not. Now, of course, this has implications for your long-term growth, for your productivity. If everyone's borrowing money to buy houses and not borrowing money to buy fancy new machines and technology to build stuff faster and better, then that's going to hurt your economy in the long run. But the Reserve Bank basically is taking the view that they just have to focus on the here and now and trying to prevent the economy going into a deep, dark hole and a lot of people losing their jobs and remaining unemployed for a long time, because that can have really nasty long-term impacts as well. So the tourist trail is going to be the most vulnerable to house price falls, but even in Queenstown, there's a few bargain hunters around thinking this might be their chance to finally buy into that market. It's been absolutely nutty, but nonetheless, Queenstown's flipped very quickly from huge population growth to depopulation. So, but it hasn't felt that bad over winter because, the New Zealanders have all been instructed to go and do something New Zealand, and go and travel around, and people have done that. So instead of being on a sunny beach in July, we were all freezing in Queenstown. But nonetheless, you can see that Queenstown incomes have been hit hard because that's the region that's had the biggest uptake of the mortgage deferral scheme, which is basically when you could stop making payments on your mortgage for 6 months, but still be counted as current in terms of, well, we don't have credit scores so much here, but yeah, how the bank treats you, whether they put a red mark next to your name, whether the bank itself has to hold more capital against your mortgage because it's deemed riskier. That was all sort of parked. But you can't do that for too long without undermining your entire banking regulation system and actually getting your customers in more trouble rather than helping them. So that has been extended, but in a much narrower way. Banks have to now prove that they think there is that the customer has reasonable prospects of resuming payments at the end of the extension. So it's not just a kick the can down the road kind of thing anymore, which is good. At some point, we do have to face up to our problems. So we've got strengths and weaknesses. The strengths, we've got a good chance of eliminating it again, helped out by our geography, of course. Our food prices, export prices are holding up and should continue to do so, particularly the stuff you buy in the supermarket, the stuff you buy in a fancy restaurant or at a dinner party to impress your boss. The venison and that sort of thing, that's struggling a bit more. But the milk powders and the good basic stuff is doing fine, which is kind of ironic given our constant quest to move up the value add chain. Our low fiscal debt start point means we have options that other countries don't have. We have quite a strong prudence kind of vibe in New Zealand with the Fiscal Responsibility Act, but I would say it's getting eroded like everywhere else as people are starting to think we've all been far too hung up on government debt and we should all just chill out. And it is actually a wonderful thing. And so I do wonder if we're going back to the 1970s. But at least if we are, then New Zealand's going is well back in terms of the starting point. Before we would end up there. Low corporate debt as well means that while SMEs tend to sail close to the wind, our corporate sector is actually in pretty good shape. Weakness is obviously our dependence on tourism. So closing the border knocks out about 5% of GDP, basically, through tourism and through foreign students and through the flow on into retail and hospitality. Naturally, there's an offset in that New Zealanders are stuck in New Zealand. But basically, through the winter, we actually run we actually run a deficit in the exports of services. There are more New Zealanders overseas than there are foreigners in New Zealand. There's just a few skiers from Japan and Australia. But come the summer, it flips around the other way. And so if you sort of boil that macroeconomic fact down to a sort of firm cash flow point of view, basically the tourism firms are used to lean winters, and they've been pleasantly surprised by the difference that the New Zealanders travelling around have made. But come summer, that filling up their buckets with the foreign tourism, it's just they're just missing hundreds of thousands of them every month. And so there will be a bunch of tourism firms that are holding on because the border closed right at the end of a really good season. But they'll be looking forward and realising they don't really have a business model and there's not going to be a miracle. But they'll be hanging on because of this tantalising prospect of a travel bubble with some states in Australia. Our dependence on immigration, that's provided, population growth's provided about half our growth since in the last 5 years. So, and it's gone to zero now. So while there's this kind of popular idea that there's a massive queue to get into New Zealand, there is, but that's because it's a very, very small gate through the quarantine system, and there's still a lot of foreigners leaving as well, and an awful lot of foreigners, of course, not arriving, who have visas and are ready to come but can't get in. So that's a big change. As I mentioned, household debt is high compared to everyone except Australia. And the New Zealand dollar is proving annoyingly resilient, but that's understandable because we are a COVID good news story and our commodity prices are holding up. So would you really want those supports to give way? Probably not. And our dependence on China, well, in January it looked like a weakness. By March it was looking like a strength again. And then then the US and China started to not get on at all, and it started to look like a weakness again. So it is both. It's a strength and a weakness, but it is what it is. China's a hugely important export market for us, the most important by far. And what's happening at the moment in the Chinese economy versus the US economy does underline that trend is not looking likely to reverse anytime soon. And there you can see our commodity prices in the orange. They're holding up really quite well when you compare with, say, the Bloomberg soft commodity index, which is things, the classic soft, like cotton and orange juice and those sort of soybeans. Our commodities are holding up better, and that's not a news story. They actually have been for a few years now, actually. And we are benefiting from the global food supply disruptions, which are not really good for the world at all, but they are good for New Zealand. So our milk price payout estimate is $6.50, which is about the line at which the average farmer is profitable. Risks may be tilted to the downside, but we'll see. The question marks are around whether China is currently stockpiling a lot, which is fun on the way up, but then when they suddenly stop buying it, it really hurts, as we found in 2015. So yeah, the tourism, a little bit more on tourism, it's 13.6% of nominal GDP. Now, actually, most of that's, a bigger portion of that is domestic tourism, but international, that's still 4.2% of nominal GDP. That's got to hurt, and you've got international education as well. Trans-Tasman bubble, yeah, well, it's popped with what happened to Melbourne, but now that Australia's talking about state by state, it's a bit more realistic. But you can see here in the industries that are most exposed to that. And there's now a link between accommodation services and the housing market through Airbnb, which has never been there before. Half of the houses built in Queenstown in the last 2 years have had a little Airbnb unit built as well, which seemed like a no-brainer at the time, but is now sitting there not necessarily earning a great deal of income, and it's extra debt. And there's the seasonality of tourism I talked about. You can see June, July and August, the fact the borders closed was kind of a net win, actually, if you, in terms of GDP. But from now on, basically, it's flipped the other way around, and those tourists will be sorely missed. Though certainly we're all thinking this is our chance to do the great walks and the great rides and all that sort of stuff while these hundreds of thousands of people aren't there. And there's the net migration. That's the numbers are very uncertain ever since we got rid of departure cards, unfortunately. So the numbers may well be revised. We're very sceptical about that sudden, inexplicable surge in net migration through 2019. But for now, at least, Statistics New Zealand are revising it up rather than down. So who knows, maybe it's real. It is probably the case that a bunch of people in 2020 haven't left New Zealand when they had thought that they were going to. And as they don't leave and stay here at least 9 months, they end up in those net migration numbers. So that's why I think it's still being revised up. It's just a very odd looking time series. So the revisions to this are enormous. So we're a little bit skeptical, but it is certainly true that net migration has dropped like a stone. But it does take sort of 3 to 6 months for that to be felt in terms of the retail sales and then into the housing market and the like. And the whole mix of migration has changed in ways we don't really understand. Fortunately, MB, the government ministry, is running a survey of Kiwis coming through the quarantine system, asking them why they're coming, where they're going, what their plans are. So that'll be really helpful data, but it hasn't been released yet. Government deficits, basically we're looking like GFC meets Christchurch earthquake, but 3 years in a row. So it's pretty huge, actually. And one day we will have to have a grown-up discussion about how we're going to pay it all back. But not in any hurry. At the moment, most of the parties seem to be talking about how they'll spend money rather than how they'll save it. And that's fair enough. This is not the time for austerity, but one day we will have to talk about it. And the New Zealand dollar, as you can see, the Reserve Bank might have hoped it would stay low when they cut the OCR, but no such luck, because of course it's a relative game and everyone else is also cutting interest rates as fast as they can. And global equities, yes, well, the New Zealand dollar is benefiting from this as well. I mean, there have been a few wobbles lately, but basically equities, US equities at least, and New Zealand equities are pretty much back where they were before COVID ever happened, which, if you just think about it in terms of the likely performance of the economy and how that will feed into company earnings, looks slightly heroic. But you can also, there's more to equity prices than that, and particularly the question, well, what else are you going to do with your money? But you have to say that risk is maybe rising because the pricing of risk is getting squashed. So you would think that people would be a little bit nervous and demanding a little bit extra return for taking risk at the moment, but no. And they're more concerned about seeking yield. And while nobody would wish for a financial crisis or even a serious bout of risk aversion at this point, it does mean that potentially people are being a little bit silly with their money because that's what the incentives are telling them to do, and that might have some repercussions down the track. So I'll leave it there because I'm out of time. There we go. Back to you, Rachel.
Thanks so much, Sharon. I guess maybe slightly more positive news than could be expected in other countries around the region. I'm sure Koen will touch on that shortly. I'm not sure that we don't have any audience Q&A for you at the moment. I do have a question though, and what are your thoughts on, so Singapore is doing industry specific kind of grants. So there's one recently that's come out where they give $100 to Singaporeans to spend on tourism within Singapore. Do you think something like that would work to kind of help keep New Zealand tourism industry alive just over the summer period?
I suppose so, but New Zealanders have really been embracing it anyway. But the issue is just a numbers game because in summer, of course, most Kiwis stay home anyway and holiday around New Zealand anyway. So I'm not sure that they're going to need a lot more incentive to do that. I think we've all got cabin fever to some extent. It's just that seasonality is really hard to get around. I guess winter would be the time if you were going to try something like that. That would be maybe the time when it could make a difference. But I think the government's tried to avoid getting too cute with its stimulus, which is probably a good move. And I guess the real test will come if the unemployment rate does indeed rise towards 10% as we expect, whether the government will be under, whoever they are, will be under huge pressure to do more and not just let the automatic stabilisers do their thing, which is basically the unemployment rate and whatnot. There's going to be a slightly awkward period between the initial support stimulus running out and then the growth stimulus of infrastructure projects and the like kicking off. They always take forever to get going, and we have to be realistic too that even though it sounds like a lot of money they're going to spend on infrastructure, it's a fraction of the business investment plans that will have been cancelled. So people sort of talk about fiscal policy as the next big thing that's going to save the world, but it's actually quite limited as well, unless you want to just throw caution completely to the wind, which you could argue some countries have done. US government debt is now as large as the US GDP. So, whereas here in New Zealand, we're targeting it to peak at about 55, and that's a very tough definition of net debt that doesn't take the super fund into account. So if you did, then we'd still not even be at the starting point of many countries. So there will be pressure for the government to do more, I don't doubt.
Okay, well, if we don't have any other questions, I'll let you run to your event with hundreds of people. And yeah, and thank you so much for your time today. Oh, 100. 100 is the limit.
Between each chair, it looks quite bizarre. Yeah.
And no hugging. Okay, and I'll hand over now to Koen. Are you there, Koen? Coming on.
Yes, I'm here.
Welcome.
Thank you very much, Rachel.
So, yeah, welcome. I'll let you talk about the impact on Singapore and aviation region.
Yeah, thanks very much. I guess first and foremost, Singapore already had their elections, and it was a watershed result by many respects. But pretty much still have the same government, so it's status quo for the time being. In terms of the New Zealand election, to be honest with you, really doesn't matter who wins, because the relationship between Singapore and New Zealand is such that whoever is in power, the relationship will remain very, very strong. Both Singapore and New Zealand just signed a comprehensive economic partnership in May, which came into force in January. And during the COVID crisis, given Singapore's reliance on importing food from overseas and the need for food security, New Zealand naturally was a partner that Singapore reached out to ensure that there was continuity of supply. So both governments signed an agreement to that effect. And again, regardless of who wins, we will continue to see very, very close economic partnership between Singapore and New Zealand. I guess the only thing from a regional perspective in terms of foreign policy and trade is Singapore and New Zealand has always tended to encourage other countries in the region to sign up to multilateralism. So we have things like the RCEP, Regional Comprehensive Economic Partnership, which we are part of. Really trying to get that through by the end of this year. So if there's a sort of a status quo type government in New Zealand, I think there's no danger to that. The only potential risk is if there's more of a swing to the left where they don't take as positive attitude towards free trade agreements, then maybe that could have some impact at the margin. But I think at this stage, there's certainly no threat to that. So in terms of how Singapore's post-COVID-19 recovery is going, I think it's fair to say the worst is over. That's the good news. The not so good news is that the long road to recovery is going to be a long and bumpy one. Now, in terms of the COVID-19 case count in Singapore, lots of good news here in that you can see from the numbers here, it's really come off very, very sharply. The number of cases being detected on a daily basis is now still in double digits, but sort of 15 to 20 odd on average. Most of them still detected in dormitories, but the cases in the community have been very, very low. And recently there has been some easing off or relaxation of some of the restrictions that have been announced. And I'm getting confident that we could be getting ready to move into phase 3 before the end of the year. That would allow more activity to take place, more gatherings, more people being allowed to return to their offices, for example. But even with the case numbers improving, the damage or the economic damage has really been done. Most of the hit happened in the first half of this year. If you look at the numbers, Q2 GDP down 13.2% year-on-year. That's the worst economic performance pretty much since independence. In the first half of this year, there were 138,000 jobs that were lost. Retail sales more than halved compared to pre-pandemic levels. And the worst hit sectors were construction and basically tourism related. So construction progress payments, because of the circuit breaker period where only essential projects were allowed to continue, we've seen almost 60% drop in payments related to work done. Hotel room revenues down 98%, and passenger movements through Changi Airport down a staggering 99.2%. Never in my lifetime would I imagine seeing numbers like those. But things have been improving, and in fact, we can trace back the absolute low point in terms of economic activity back to about late April or early May. And several things that we track in terms of real-time data. This is a very useful one from Google, thanks to the wonders of technology and also the ability to trace our whereabouts, whether knowingly or unknowingly. It's provided a rich source of data for us to rely on. And you can see from this, mobility really plummeted when the circuit breaker period began, but started to recover from about early May. And the recovery has been gradual, helped by phases when there were easing in restrictions, and particularly when we moved out of the circuit breaker period and moved into phase 2. But you can see more recently, the mobility has really started to peter off. So we actually haven't seen any further material improvement just in the past month or so. And the level of activity, or in terms of movement, is still about 15% down from January levels. So we've recovered from the worst, but still anywhere near back to some normal levels yet. And it's the same picture when we look at daily electricity demand data. Again, this is a very, very good data to tell us how activity is shaping up. And demand for electricity really plummeted when the country moved into the circuit breaker period. Many businesses were forced to shut. And again, very consistent with the mobility data. The low point was really around late April, early May, and since then, demand for electricity has started to pick up. But again, it's consistent with the mobility data. We've just sort of seen some easing off in the past month, as there really didn't seem to be any further impetus in terms of the recovery gaining more traction. So compared to last year's levels, electricity demand is still a good 10-15% below where it was, indicating that yes, we have recovered from the absolute lows in the middle of the year, but we're still some way off from getting back to where we were pre-pandemic. Now, the economic damage clearly would have been far worse if not for the massive fiscal support that the Singapore government had provided. This chart here just looks at a comparison of the amount of fiscal stimulus support provided by various governments. And there are different channels that governments have provided support. There are some that are just outright cash handouts or wage subsidy schemes like Singapore's job support scheme, cash handouts to households, and various other forms. There are also other types of assistance, such as loan deferrals, for example, or debt relief programs, regulatory forbearance, things like that are also equally important. But if you look at the composition of Singapore's fiscal support, it's actually one of the most generous in the region, close to 20% of GDP, spanning over 4 budgets. And importantly, it's the direct spending that is also the largest in the region. Even though Malaysia's overall fiscal stimulus slightly more than Singapore's at over 20%, you can see for Malaysia, a lot of it is just things like loan guarantees and debt relief. In Malaysia, the actual money spent or cash in their hands transferred into households and businesses is only around 4% of GDP, whereas in Singapore it's a massive 15% of GDP. So that fiscal support measure has been really, really important in keeping as many jobs and as many businesses hanging on there as possible. And we can see that in the unemployment rate. So even though, yes, we have lost 38,000 jobs in the first half, the unemployment rate hasn't actually spiked up as much as it has compared to prior recession periods. Now, part of this is because a lot of those that lost their jobs might be foreign workers, and they pretty much effectively had to leave if they were allowed to leave, and therefore they were not counted as part of the pool of unemployed. Also, as tends to happen during periods of economic recessions, those that have lost their job because they were discouraged, they pull themselves out from the labor force, so they were not counted as unemployed. But in many respects, some of them were able to do that partly because of some of the fiscal benefits that were provided, allowing them to do that. I think what's remarkable is if you look at the number of business foreclosures or insolvencies, they've actually been very, very low. Now, over the early part of this year, because of the circuit breaker, obviously all the government departments were closed, so companies could actually file for bankruptcy, even if they have gone bankrupt. But since the circuit breaker period has ended, we actually didn't really see a massive spike or a huge wave of bankruptcies as I would have expected. In fact, it's actually fallen. I think partly it could be a timing issue. As I mentioned, there was a lot of support provided by the government, things like the job support scheme, for example, provided direct cash transfers from the government to businesses to retain as many staff as possible. The debt relief program allowed businesses to basically defer payment of principal until the end of this year, and now the MAS is in talks with banks to potentially extend that to the middle of next year. So all these things actually helped businesses basically hang in there. But with the recovery currently underway, I think there's going to be potential for some businesses to be able to to work their way through. But there will be some that will not make it. I think that is the harsh reality we have to face, particularly as some of these support measures start to expire. Now, thankfully, Singapore does not face a massive fiscal cliff in the immediate future. The job support scheme has been extended. It's less generous compared to the first wave, but nonetheless it's still there. And as I mentioned, if the debt relief program is extended further for another 6 months, that's going to be a huge cash flow relief for a lot of businesses that were worried about potentially facing a need to start repayment by the end of this year. So if there's another 6 months saving grace, that could make the difference between them hanging on there and hopefully the recovery that's underway will allow them to generate enough business revenues, or at least give them time to reinvent themselves, come up with new business models to be able to survive in a new environment. Now, in terms of the recovery, as I mentioned earlier, it's going to be a very uneven, bumpy, long road ahead. And different sectors will fare very, very differently. This recovery is not going to be the same throughout all sectors. Now, the COVID hit everybody pretty badly. Unfortunately, on the way up, it's not going to benefit everyone. So any business that's exposed to international travel, tourism, sad reality, you're not going to see a return to normality for a long, long time. Borders are still closed, and while there are talks of travel corridors, for example, so far that hasn't really come to fruition yet. And even if we were to get travel corridors put in place, we are still not sure how consumers are going to respond to that. Will people be willing to necessarily hop on a plane go for their overseas travel when there are still second, third wave outbreaks happening in some parts of the world. So that consumer caution, I think, is a huge unknown in terms of the shape of the recovery. And it's the same with businesses as well. This cautious behavior has important implications because it determines their spending patterns, their ability or their willingness to invest, for example. So if households are cautious, they don't really spend, even though the situation might improve, but they feel cautious, they actually feel a need to save up more, it's precautionary savings. Then they spend less, and that actually slows down the recovery. And then businesses, for their part, seeing that demand hasn't really picked up, they are cautious, they go on the defensive, they don't hire, they might continue to cut costs or not invest at all. And we end up with this very, very stagnant period where not a whole lot of new activity is generated just because everyone is just being super cautious. So I think that's a big risk we're facing, and it certainly feels like that is where we have been in the last few weeks, where a lot of those mobility and electricity data that I've showed you earlier, after the nice pickup from May, it sort of just started to stall in the past month or so. So I think we really need another catalyst to get another bout of activity going, and I'm hoping that with the better containment of the outbreak, hopefully we get more easing of restrictions that will create another wave of activity. Chinese economic activity is actually going very, very nicely. Their recovery continues to gather momentum, and hopefully that will start to spill over into Singapore as well. There's a couple of areas in Singapore that actually continue to do quite well. It's largely on the manufacturing sector. Anything to do with biotech and technology exports has seen continued strong demand, and that's reflected in Singapore's pretty decent export numbers so far, holding up pretty well. The biomedical cluster has been operating at very, very strong capacity as demand for those products have really gone through the roof. Anything tech related, particularly relating to cloud, has also seen very, very strong demand. And actually, this is one area where we have seen increasing demand, both in terms of investment and jobs, by companies such as Zoom, which is setting up operations in Singapore, and Tencent also indicating they're going to set up a regional hub in Singapore to service the region. So once again, for Singapore, that is its main strong comparative advantage. Population might be small, we don't have a big domestic market to rely on, but our location, the skills, and more importantly, the strategic location continues to attract businesses to come into the country to invest, particularly increasingly now related to technology, service-related sectors. So the days of attracting manufacturing is gone, and we're not going to go back to that period again, simply because it's too expensive, and countries like Vietnam are a whole lot more attractive. Singapore is now attracting a new host of FDI coming in, more around technology, services, and I think that is definitely one area where the government is very keen to continue to attract businesses and ensure that the labor force is skilled up. So I think the government has recognized the need to digitize very quickly, bring the labor force up to scratch, which is why they have provided plenty of incentives for the population to retrain, to upskill. And there have been grants being provided to businesses as well to basically revamp and upgrade their technology. So the government recognizes this. They're throwing a lot of money into this. Now, one thing we will get out of this as we continue to recover is that we're probably going to end up with more industry concentration. One thing we have seen during the pandemic and the economic recession is that it's the smaller firms that tend to suffer and basically forced to go under. That's because they didn't have the technology necessarily or the ability to manage working from home or not having a physical presence. And what we're going to end up with is basically more of an industry concentration. It might not be a bad thing in some sense. If you get more concentration, then you get a bigger entity, which is hopefully more innovative, more resilient, and as long as they can do well, then they will continue to hire and invest. But it's just that it's going to be a period where just general uncertainty, where we'll still see business failings, business closures. That will probably dominate in the near term before these other businesses can actually scale up and actually do much better. And of course, needless to say, we've seen this all over the world. National champions will be favored. And we will definitely see, at least in the very least, national champions will continue to survive, and they'll get the resources needed and get ready to take advantage of the upswing when it comes. In terms of our growth forecast for Singapore, this is how it's looking like at the moment. In terms of the level of real GDP, you can see there was a massive slump in the first half, and while we're expecting GDP levels to increase, we are not expecting the level of economic activity to be back to pre-pandemic levels until at least middle of 2022. So actually there's quite a big hole that will not be filled in for quite a while. Very hard to see how we can get a much faster recovery before then. Absent of a magic vaccine breakthrough, that would be fantastic if that was to happen, but I think I don't want to be too overly optimistic in hanging my hopes on a strong recovery on the back of that. So for now, I'm taking a more cautious approach, and the recovery is underway, but it's going to be long and bumpy road ahead, as I mentioned. And that's just a more detailed forecast for Singapore. So that's it for my presentation. Thank you very much.
Thank you so much for the insight, Koen. It's yeah, I think it's fair to say it's probably going to get a little bit worse before it gets better, but nice to see that there is some positivity coming, I guess, 2022. So I'll just check if we've got any questions. We don't seem to have any questions from the audience today. So clearly you've covered everything that everyone wanted to know in your presentation, which is fantastic. So thank you so much for your time again today, and in absentee, I'll thank Sharon as well. We always appreciate these updates, and at the moment, the forecasts and the commentary seems to be changing by the week, so it is really useful to get these updates more than we would possibly in normal times. So thanks everyone for attending. Thanks, Koen, for your presentation, and we'll see you again soon.
Thanks everyone. Stay safe.
Cheers.